everybody. We're glad to see you tonight. And thank you for bearing with us as we had a little technical issues, but we're all resolved and we're glad to be here tonight. Each month, we host a business roundtable focusing on a local business owned by a person of color in Howard County. The roundtable guest shares the experiences and challenges they face as a local business owner, so you can learn what it takes to start your own successful business. The discussion tonight is moderated by Nat Alston, chair and founder of the Ujamaa Business Roundtable. Thank you all for joining us tonight. This is a webinar. We will take questions in the Q&A and the chat throughout the presentation. The roundtable normally meets on the fourth Tuesday of the month at 7 p.m. So mark your calendar to join us. And without further ado, I'm going to turn it over to Nat to introduce our featured guest this evening. Welcome in, everyone.
All righty, welcome. And thank you, Nancy, for the introduction. And just for Nancy's ideas too, this is a collaboration between Howard County Library and the Ujamaa Business Roundtable. And again, we want to thank the Howard County Library and my dear friend Nancy for allowing us to share this collaboration tonight. And with us tonight is Mr. Financial himself, as I'm going to have some fun and tease him a little bit. Yes, sir. This is Mr. Dale Dix, President and CEO of SageOne Financial. And for our listening audience tonight, he's going to talk about his business, but also if you've got possibly any general financial questions, he can definitely answer that and definitely have some follow-up with you, because we've got a lot to talk about tonight, not just far as starting that business, but his view as the financial health and well-being of our family members, our general population in general, and what they can do to really ensure that they've got a very strong financial future. So Dale, welcome to our Business Roundtable tonight.
Hey, thank you so much for having me. I'm so happy to be here.
Pleasure is ours. And kicking it off, when we talk about entrepreneurship and starting their own business, I'm going to have you start off with your background. I know for some of our listening audience, you've got a military background, but I want you to share that and then also share the transition from your military background now into what you're doing right now as the CEO of SageOne Financial. So share with us your story.
Okay. Well, Nat, my story, I reflected on, as I prepared for tonight, I thought about, my story, and it came to mind that I first got the idea about financial services when I was in high school. And one day I was riding around with my father, and we always took that opportunity to have a dialogue, and he always talked to me like I was an adult. so he suggested that, son, you might consider being a life insurance agent when you're ready to go into a career. And we had never talked about that before, and we never talked about it since, but it stuck in my head. And so I graduated from college. I went into the Marine Corps. As you know, I spent 20 years there. I was an aircraft maintenance officer, was my primary trade there. I got a master's degree in financial management. I got an undergraduate degree in business administration. So my interest was always on business. And then upon retiring from the Marine Corps, well, I had a major decision to make. What's next? Right? I had no clue. And I decided that idea of life insurance came back to me. And I said, I don't know how long it's going to take me to get a job. I don't know what it is exactly I want to do. So why don't I get my life insurance license? And at least I'll be able to make, I'll have a means to making a living while I figured out exactly what I wanted to do. And that's what I did. And within very short order, I received an opportunity to work for Fannie Mae.
Oh, okay.
And so I went to Fannie Mae, and I was in charge of diversity and inclusion training there. Because I didn't have a history or a career background in finances, I couldn't really market myself, for a financial position. So I figured I'd get my foot in the door with something I knew about, right? So they gave me that opportunity. And over time, I got more and more opportunity to work with lenders, to work with realtors, and to work with community-based nonprofits in the housing industry. So when it was time for me to retire, or should I say, when I reached age 50 and they offered me an early retirement, right, a package, I decided it was time to go.
Okay.
So I took that opportunity and I became an entrepreneur in January of 2008. I had my life insurance license while I was at Fannie Mae. So I was working part-time as a life insurance agent. And I was also working in a mortgage company. Didn't have my license, but I was doing work within a mortgage company. And then when I retired from Fannie Mae, I got my licenses in real estate and mortgages. And I figured that anytime I sat down at the table, I wasn't going to walk away with nothing. Right? Because the clients for those three industries are the same people.
Right,
you know,
right.
And everything is related. So that's how I got started. And for the last 23 years, I have either been on a part-time or full-time basis working in this industry.
So you started off, as you said, leaving Fannie Mae and all, and you had that background and basis in the area of mortgage and real estate. How did it from that, and I would assume which came first, the mortgage and then the real estate, how did it evolve into SageOne Financial, so to speak?
Well, SageOne Financial was there in the beginning as a life insurance sales company, okay? And then upon retiring from Fannie Mae, as I said, I got my license in mortgages, I got my license in real estate. And but of course, that was in 2008. And we all recall what happened in 2008.
Oh, yeah. Many of us around remember that 2008. Absolutely.
It was the worst. It was the worst time in the world to go.
Worst time to start and jump out there on your own, right?
Yes, yes. So I struggled for about 3 or 4 years there. But the only thing that persisted was the life insurance.
Okay.
Even in that very unstable financial market, the life insurance business was still profitable.
Right, right.
So I learned then that of all the things that I had put my hands into, that life insurance was my mainstay. And then over time, it became more of a focus on retirement planning and then financial education.
Okay. That's very interesting how that life insurance evolved into that. And really, let me flash back during that 2008, 2011, that 3 years in there, because that 2008 didn't finish in 1 year. It lasted some time.
It did.
How did you survive in terms of really getting clients and understanding, hey, you're out here on your own and you've got to survive.
Right.
And it's in a tight market. And granted, you said that you found out later on that that's what you would call maybe a bellwether, not so much a bellwether, but it's an industry that can weather the storm, so to speak.
Yes.
So how was it in navigating those storms of a recession?
That's a very good question. And the reality is that I had to go into a segment of the insurance market that I'd not been in before. I literally went into final expense sales. Okay.
Tell us about that. What is that? What is that?
That's burial insurance. That's that small whole life policy that people buy for the end, to put someone in the ground and to pay off any expenses. I'd never ventured down that path before, but that's where I found opportunity. I literally knocked on doors, just showed up, just showed up on people's steps and knocked on doors and watched people look at me through the window and I'd say, I'm not home.
So you were that back in those days, what we call way back, that door-to-door salesperson.
Yes, I did that for 4 years as I had to weather the storm.
Okay.
I learned a new segment of the industry. And by now I've spent time in just about every segment of the industry. So I feel pretty well equipped.
Right. Wow. That's for our business owners out there now that, hey, you got to pound that pavement sometimes to really keep your dream alive and keep the perseverance in there. Was it ever any time during that time, and we'll get to some other questions, but was it ever during that time that you felt, okay, enough already? I've been out here for a while and I don't see, hopefully, the light in the end of the tunnel. I hope there's the end of the tunnel, not a railroad, a train coming to me. So did you ever feel that way?
I did, Matt, but my saving grace was the fact that, and I knew this coming in, I had a military retirement check.
Okay.
And I had a retirement check from Fannie Mae.
Okay.
So I felt that this was the first time in my life that I really had an opportunity to do what I wanted to do.
Okay.
Yeah, my income wasn't what I wanted it to be, but I could budget on that.
Okay.
Okay. So I was determined to make it, and I haven't looked back. I've been out here since.
Okay. And you
Okay.
mentioned two things in there. You had two pensions that really discipline you to budget. So you could have the freedom, if you will, to go out there and venture. And that's
Right.
something, I guess, also, and I'm keying on the word that you said, hey, I had to stay budget. And from the flip side that we'll get into a little bit later in terms of how people now can move their wealth and, shall we say, live comfortably, but at the same time plan for the future.
Mm-hmm.
So let me segue in here now. You've evolved now after being in all the industry, the aspects of the industry. You're now looking at the idea of being a, quote, financial planner. What does that mean to you, and what would that mean also to our listening audience?
Okay, I'm going to address that question, Nat, by first delineating between what a real financial planner is and what I am.
Okay,
Because
great.
I'm not really at liberty to say if I have a business card to put on it financial planner, because that requires a certification that I don't have.
Okay, okay.
Now, I have started down that path a number of times, but in each case, I resolved that, I don't really believe in what they do.
Interesting.
Okay? Meaning that financial planners and many people in the financial industry focus on products that are in the market.
Okay.
Which means that your principal is not protected. And it's almost analogous to gambling, because nobody knows what the market's going to do at any time.
True.
So the more I studied, the more learned I became in the financial industry or sector, I just decided that I'm not going to sell somebody something that I wouldn't buy myself. And again, I have an aversion, if you will, to that level of risk. Okay, and so I'm not suggesting that risk is all bad. But I think that a methodology needs to be applied to determine what percentage of your portfolio you're willing to expose to risk.
Okay.
I like to share with my clients the rule of 100. And the rule of 100 is simply a rule of thumb. And you take your age, you subtract it from the number 100. The difference is that percent of your portfolio that you can reasonably expose to risk, if any at all. And of course, the balance is that portion that should be in something more conservative, that's principal protected. And those products are namely annuities, bonds, and life insurance.
Okay.
Cash value life insurance.
Okay. And that's interesting when you said the protecting your investments and being conservative, but also what percentage you want to really enjoy maybe the risk out there. That is fantastic. One of the things that after meeting with you and talking with you too, what were some of the challenges, or are some of the challenges now that you're seeing in the business that you're in? You've seen it go from the recession of 2008. Now we're in 2022 with COVID in there. That is, I would think, has changed the whole scope of every industry. Has that happened to you or happened to your industry? And if it has, what are some of the effects or some of the issues that now you're having to address?
Well, Nat, very interestingly, COVID has had an opposite effect on my industry.
Okay.
As a matter of fact, the insurance management organizations that I affiliate with, we have had record-breaking sales and growth month after month after month during COVID. Now, we might ask, well, why is that? Well, I believe that one thing that COVID has done that's been favorable to our industry is that it has really awakened people in terms of people are really thinking about what's important to them. Okay. And when they start thinking that way, they start to take a closer look at things like their insurance, You know, things like their retirement plans.
Mhm.
How much money do I need to have in place? How long will it last? Do you know that people are today, because people are living longer, most people are more concerned about outliving their money than they are about dying. Okay.
Okay.
And if you didn't know, right now, we are going through the biggest transfer of wealth in the history of the world. And that transfer is expected to continue to take place over the next 30 to 40 years. This is the best time ever to be in my industry.
Granted, you brought a term out there, or transferring of wealth or generational wealth, to our listening audience. Elaborate on that really. What are you talking about, the greatest transference of wealth?
Okay, well, especially with the baby boomers made quite a bit of money. And as a matter of fact, subsequent generations, or generations that came after the baby boomers, I think most of us would acknowledge, just looking around, they're not going to have it as good as the baby boomers.
Okay.
The pension programs, in large part, that were there for baby boomers are no longer there. The retirement programs today are all self-contributory, 401ks, et cetera, right? So it's going to be different for those who came behind us. But because the baby boomers and the generation before them did so well, they've amassed a lot of wealth. And as they age, guess what? That wealth is transferring back to generations, right? And every time there's a transfer of wealth, there's somebody in the middle, like me, who has to be involved to oversee the transfer of that wealth.
Gotcha.
And that's why, you know, we don't have enough people right now in my industry to handle it all.
Really?
No. And the average age of life insurance agents is between 60 and 65. So,
really?
So we have an old and understaffed force. So recruiting younger generations is a big part of what we have to do today.
Okay. So you're out there needing those younger people in there, and I'm not saying young, but in that 35, 45 range of new people coming in and educating them so they can take that ball and run with it, so to speak.
Yes, so that's a big part of my business. You know, it's as much to sell as it is, or it's as much to recruit and train and educate and bring people in behind me and start to expand my business across the country. That's where my focus is.
Now, how do you go about encountering let's say a person now that you want to recruit? What would you do, or who's the ideal recruit for your industry?
Well, that's an interesting question. We have, with the mass exodus from corporate America, there are lots of folks out there today. The great resignation. And,
I understand, yeah.
So the ideal recruit, of course, is a young professional. Okay. But yet there are exceptions. So there are people out there who may be laborers just by chance. Okay, but they're perfectly capable of transitioning into this professional environment and with the education and the skills that we can train them sufficiently so that they can go out and do this business.
So you've got a recruiting function in there, as well as an education function in there. And I'm going now, Dale, to our panelists, our attendees. Nan has in the chat room. Dale, why should I have a life insurance policy be part of my budget plan?
Okay. Let me say this, that anyone who is getting started or who is interested in building wealth, okay, and part of the reason for building that wealth, which I think you wanted to talk about when you mentioned generational wealth, Nat, but I went in another direction. I didn't get
back. That's okay. You got time. Go right ahead.
But the foundation to any wealth building effort is life insurance. Okay. And the reason that is true is, well, guess what? If you've got a young family and let's say you got a working husband and wife, both of those and all of their income typically is part of that family budget. So what if, unfortunately, something were to happen to them prematurely? one of them, that annual income has now gone away. So the first purpose of having life insurance is to get a life insurance policy, and it could be a term policy, anything, as long as it can replace the income.
Okay.
When that one spouse passes, so that the family doesn't have to be uprooted, because without that life insurance, in all likelihood, the family's going to have to move out of their house because they can no longer afford it, et cetera, et cetera. So life insurance is intended to replace income, and it's the first step in starting the journey to building wealth.
And if you're looking at the same thing, okay, another question she's in there. Can you age out of the need for life insurance?
Well, you can, but you need to have something like an annuity. Most at one time, you've probably heard of buy term and invest the difference.
Mm-hmm.
That was very popular 30, 35 years ago. But I found as I was selling final expense insurance, I would run into people who had reached 65. They'd reached the end of that term. Now they didn't have anything, and they were mad. They were mad because they're now 65, 70 years old and they don't have anything.
Right.
Now you might say, well, why do they need anything? Well, what they need most is that final expense. If they don't have life insurance and general life insurance,
Right.
They at least need that final expense so that their loved ones can put them to rest without having to pass the hat around.
Right.
Okay.
Understand. Yeah. I mean, you and I've talked many times on that, and myself being an HR professional and really doing consulting, I would help companies design, as you said, as far as the baby boomers. We created our generation created the Social Security. We also created the 401ks, the 403bs, and the annuities in there because we wanted to have that. And you're right. We reached the age now that we want to have that financial security and making sure that we've got that generational wealth in there. So back to Nan's question, can you age out? I would say, Nan, as a personal standpoint, you can't. You really got to have that financial security in there so you can plan for that. Would you agree, Dale?
Well, I would say that I would agree in part.
Mm-hmm.
I would say that what you really need at that point in life, because the housemate is probably paid for, I don't know. But see, that's a major consideration, because one reason to acquire term insurance is to act as mortgage insurance. It's the best mortgage insurance you can buy.
Okay.
Most cost effective. Okay. So in terms of answering that question, it depends. They're 65-year-olds now going out and getting a new mortgage.
Okay.
I'd say that 65-year-old needs a life insurance.
Well, you start hearing all of this now about life insurance, reverse mortgages, all of those things out there. And I advise some of my clients out there from the HR standpoint. I said, when you start thinking about retirement, next to the doctor, your financial planner is probably the closest person that should be to you in terms of reviewing your portfolio and just where you're going, because we are living longer.
Right.
And now there's a new product out there that I know you're aware of, long-term insurance.
Yeah, long-term care.
Long-term care. Any opinions or comments on that?
Yes, I got a lot of strong opinions on that.
Okay.
and there was a time, Nat, when long-term care was really not a good deal. Okay. And I remember when I was just after I turned 40 years old, when I was retiring from Fannie Mae, I was 43. And I was rushing to try to get a long-term care policy, man. There was one out there that I loved. I saw it and I said, oh my goodness, that's a dream. And before I could get my paperwork through, they had canceled that particular policy and come out with a new one that was not nearly as good. And therefore I didn't purchase it. Now I'm glad I didn't, because what I always disliked about long-term care is that it's an insurance that if you don't use it, you lose it.
Okay.
So you spend all these years, and it's expensive. So you spend all these years putting a lot of money toward it, and you don't use it and you don't ever see anything in return. Now, granted, I don't want to use it. Right? I really don't want to use it, right?
Right.
But today, for everybody's information out there, today you can get a term policy that has a rider on it that will cover your long-term care needs, as well as permanent policies that have a rider on it that covers your long-term care needs.
Mhm.
Now, in most cases, it's not called long-term care rider. In most cases, it's called chronic illness. Okay, but it works just like a long-term care policy.
Mhm.
A long-term care policy, to be paid on a long-term care policy, the trigger is to not be able to do at least 2 of your daily activities of living. And those daily activities of living are bathing, continence, dressing, eating, toileting, and transferring.
Say that again.
Transferring.
Say that again for our people.
Okay, the 6 activities of daily living are bathing, continence, dressing, eating, toileting, and transiting.
Okay, now some
And
of
if you-
those we already, it seems obvious on the meaning of that. Others may not. Elaborate if you don't mind.
Okay, well, bathing is easy, right?
Right.
Can you bathe yourself?
Mhm.
Continence means, can you control your bowels?
Okay.
Dressing means, can you dress yourself? Eating, of course, can you eat by yourself?
Mhm.
Toileting, can you go to the bathroom by yourself? And transiting, meaning, can you get out of the bed and move around in the house to where you want to go, whether it means you can get in a wheelchair, you can have a crutch, a cane. Can you get there by yourself?
Okay.
That's transiting. So if you cannot do any 2 of those 6 activities, then your long-term care benefit is triggered.
Okay.
Okay.
Interesting.
Now, a chronic illness rider on a life insurance policy, whether it be a term policy or a whole life policy, is triggered by the same.
Mhm.
And the other thing that it's triggered by, in addition to those 6 activities, is your mind. If you have Alzheimer's, then that would trigger as well.
Okay.
So your cognitive ability.
Okay.
Okay.
Another
Now,
question. Go ahead. No,
excuse me.
please.
So let me tell you the value of having this long-term care capability with your life insurance policy. You might pay $500, $700, $800 a month today for a long-term care policy. That's worth a darn. Okay. And there's still going to be perhaps a delay in terms of, you have to be laid up maybe for 30 days or 45 days before it kicks in. Okay. But you can get a very comparable and competitive coverage with a life insurance policy, and you really don't have to pay anything extra for that rider.
Okay.
And with most of my individual universal life insurance contracts, when you get your policy, it'll tell you what your lump sum benefit would be for long-term care, and you get it monthly. Okay, so it's not uncommon to get $5,000, $6,000, $10,000 a month. And in Maryland, the average cost of long-term care is $6,000 a month. At least it was a few years ago. It may be $7,200 now.
Right.
So something like long-term care can be catastrophic to a family.
Gotcha. So we focus really on the last several minutes on the long-term care for our seniors out there. What would you say to a person that's in their 20s, just starting out, in terms of really, should they have a financial planner? If the answer is yes, if I'm in my 20-somethings, Gen Z or whatever, and I'm thinking, hey, that's something that I really shouldn't be worried about or care about, but not even long-term care, but just basically generational accumulation of wealth and all to a 20-something or 30-something, what would you advise them, Dale, to do?
Okay, if you don't mind, I want to go back to the beginning in terms of generational wealth.
Sure.
I've not addressed that adequately.
Sure.
But I looked up the definition of generational wealth. And according to the definition, generational wealth refers to financial assets passed by one generation of a family to another.
Mhm.
Those assets can include cash, stocks, bonds, and other investments, as well as cash value life insurance, real estate, and family businesses. Generational wealth is achieved when you've accumulated enough investments to pay for your family's living expenses in perpetuity without touching the principal.
Interesting. Okay.
So let's talk about that for just a moment.
Sure.
Because Nat, for years, because nobody told me, I would struggle thinking about, okay, I save up, I amass this money for the future, for my retirement. One, how much does it need to be? And as I envisioned it, it appeared to me and intuitively that I would spend that money down to zero over time. That was the way I saw it. That was my thinking. It was years later that I learned that from a financial planner's perspective, okay, if I had $1 million in my account, they had a formula, and years ago they used 5%. Today it's down to 4%. But basically, the way they use that is they would say that 5% of that money that you've amassed should be used for your annual income.
Okay.
Now, 5% of $1 million is $50,000.
Right, right.
And for most of us, we haven't paid taxes on that money yet. So if you're in a 30% tax bracket, that's $15,000 in taxes. That means your net's gonna be $35,000. Now you got to live on $35,000 a year, and you got $1 million in the bank. That just doesn't seem right, does it?
Right.
But that idea of living on the principal is in line with that definition that I just read.
Okay.
Right. So it just goes to show you that from a financial perspective, the goal is, in terms of transferring wealth or passing on a legacy, you need to be in a situation where you're not spending down your principal.
Okay.
You can live on your interest.
Gotcha.
Okay. So that increases what your goal needs to be significantly. Does that make sense?
Yes. Very much so.
Hey, Nat,
Yes.
I also wanted to mention, I'm sorry. I
ahead.
also wanted to mention, one of my favorite things to mention is, if you were a farmer and you had a choice between paying taxes on the seed or the harvest, which would you choose?
That's a very interesting question. Very interesting question.
You know, let's imagine it this way. A farmer goes to the general store at the beginning of the season, the planting season, and spends $1,000 for seed. At the end of the season, when he goes in for harvest, the crop harvest has a harvest of $50,000. Now the question was, would you rather pay tax on the seed amount or the harvest amount?
Now I'm going to interrupt you and turn it around, and not so much turn it around, but invite our attendees. Attendees, put in the chat, what would you do? Dale has posed a question to you. Would you want to pay the tax on the seed? Or do you want to pay the tax on what? The harvest. So we've got one saying the seed. Okay. Let me see. Anyone else who feels bold enough to put it in the chat and see what you have. Okay. I've got two saying the seed. We've got two more attendees out there that haven't responded yet. So if you can, please do that. Again, do you want to pay taxes if you're the farmer? And you've got two options, paying taxes on the seed, or would you pay taxes on the harvest? We've got 3 seeds in there now. One more person. I'm waiting for one more person in there. Don't want to call you out, but you know who you are. So you want to put it in the chat? If not, I understand. So Dale, we've got 3 people who are saying they'd rather pay taxes on the seed. So I'm gonna let you answer that in whatever shape or form that you want, or give us both rationales and then come up with the best choice. So I'll let you answer that the way that you want. Go ahead.
Okay, so anybody who answered or responded the seed, they were probably listening closely when I explained that the farmer would pay $1,000 for the seed and then would make $50,000 at harvest. And they figured out I'd rather pay 30% on $1,000 than 30% on 50,000. So that's how they would conclude that I'd rather pay tax on the seed. Okay. But then most people will respond that way, of course. But then my next question, Nat, is why is it that when it comes to your retirement account, you did the opposite? You put your retirement money in a qualified plan, which allows you not to pay tax on the seed, just so you can wait until you retire and pay tax on that money as it comes to you in the form of income, which is the harvest. So you avoided paying the small amount of tax up front that you would never have to pay tax on that money again. In exchange, you waited, you let the money grow to a much bigger amount, and you waited to take income and pay tax at that time. Now, most of us do that unknowingly.
Yeah, I was going to say most of us have done that unknowingly and always think, because those plans, I would assume, I know when I was shaping those out, it was always say, hey, let's defer that. Let's always defer that till you reach a certain retirement age. So you're not going to pay taxes, because a lot of these 401ks were written that way.
I know.
Yeah.
And they were intended to bamboozle us.
Yeah. Yeah.
Okay. And they were very successful.
Oh, they're extremely successful. I mean, hey, I'm going to say that I was part of that crowd like many others.
I was too, Nat.
Yeah.
It was before I knew better. Okay.
We said, oh, okay, I don't have to pay taxes on it right now. It was never even told to me the way that you're talking about it now as a farmer, the seed versus the harvest. We basically said, hey, I'm right there at my seed planting days, and the income is not that much, but hey, if I don't have to pay, quote, taxes on that and defer it, that sounds good.
Right. It does sound good.
Yeah.
You have to you have to really understand some things in order to figure it out. Right. Mm-hmm. And when I break it down to you in those simple terms of the example of the farm and the seed and the harvest, it's easy for anyone to understand. Now, let me say, go ahead.
So what you're saying is, too, for our listening audience out there and for the recording, if I'm a young person in that range of, let's say, 25 to 35, and a company is offering me this type of a 401k or 403b or whatever, you're encouraging me to do what?
Well, if you believe the example that I gave you, okay, then that basically tells you that what they're offering you is not a good deal.
Okay.
And if there's a better deal, for instance, if there's a deal out there where you can literally pay tax on the seed and not the harvest, then you need to be looking for that. And I can tell you where it is. Okay. Now, there are a couple examples. For instance, a Roth IRA.
Okay.
Okay. A Roth IRA gives you the option to pay tax on the seed and take after-tax dollars and put in the Roth IRA, and you never have to pay tax on it again.
Okay.
Okay. But I don't sell Roth IRAs, so I don't promote them. But fortunately, I have a product that gives you far more advantages than the Roth IRA, because beyond just being able to pay tax on the seed as opposed to the harvest, with a cash value life insurance policy, okay, you can grow that money tax-free, just like with a Roth. You can take it out in retirement tax-free, but then you can also pass it on to your heirs tax-free. You can't do that with a Roth.
Gotcha.
Okay. And you can use a life insurance policy like the bank. You can be your own bank with a cash value life insurance policy. Now, what does that mean? That means I can put all my money in that policy, have it build up in cash value, which is like a savings in that life insurance policy. I can borrow money from it, use it to purchase another asset, and it doesn't disrupt the growth of my money that I had in there in the beginning. For example, if I got 100,000 in there and I need 50,000 to buy a car, I can borrow that from the insurance company. They use my policy, the cash value of my policy, as collateral. They don't touch it. So it's still earning money while I borrowed it and I used it for something else. Now, in the case of an investment, I could take that money and go buy some real estate, make a profit on it, pay myself back, and I'm still ahead of the game.
Gotcha.
There's
Gotcha.
nothing else. There's nothing else that works that way.
Gotcha. Gotcha. Now, I'm making assumption on our attendees. I think that they may end up being, or they are rather, business owners themselves. And so, Dale, the question would be, if I'm a business owner and I'm one of the attendees here, what should I do if I'm an entrepreneur, business owner, in terms of financial wealth, generational wealth? How should I protect my business and me financially? What would you advise me?
Okay. Let me qualify my response this way.
Okay.
One, my primary expertise at this time is individual life insurance. So I'm not an expert when it comes to how to protect your business.
Okay.
There are instruments out there that are used for that purpose. But what I can do is help a business owner in terms of their personal creation of wealth.
Okay.
And preparing for retirement. So my products are perfectly well suited for that.
And I can understand that, where from a business owner standpoint, that they would definitely want to protect the individual, the owner, him or herself first, and then look at the business being protected later on, particularly if they're growing the business and then later on looking at maybe a 457, what we call a top hat program or something out there in regards to that. But you're saying, and I agree, let's take care of you as the individual first.
Yes.
And then the business would be second.
Yes.
Absolutely.
And many times I'll work with a small business owner who may have employees, but they may not have benefits for those employees. I can come in and offer what I do to the business owner, and then turn around and offer similar products and services to his or her employees.
Great.
And still putting all of them in a better situation.
Super. We've got another question in the chat also, Dale. Don't know if this may be under your area of expertise, but we've got a question saying, any advice for someone with credit card debt? Any advice that you would give as far as a financial planner? If I'm in credit card debt, what advice would you give me?
Hey, I'm going to have to say that I'm going to be in that business real soon.
Okay.
I've been working on it. Okay. Right now. So the answer to that question is, I'm not positioned right now to help, but there are services out there that can be helpful. And I'm in the process of positioning myself so that I can use that.
Okay.
Up until now, when it comes to debt, my primary focus has been helping people get out of debt at an accelerated pace.
Okay.
And that includes credit card debt, that includes student tuition debt, and that includes mortgages. And as I said in my write-up, my whole goal in life is to show people how to simultaneously accumulate wealth and eliminate all of their debt, including their mortgage, in as few as 5 to 7 years. Now, let me tell you how important that is. The typical person with a 30-year mortgage, that means that you signed a contract and you're going to be in debt to that mortgage for the next 30 years. And let's just use the example. Let's say your mortgage was just $2,000 a month. That's $24,000 a year. Now, what if instead of paying that payment for the next 30 years, buying 2 houses, I'll mind you, with all the interest you're gonna pay, right? So what if, rather than do that, I can show you, without disrupting your quality of life and without disrupting your cash flow any major degree, using the same money, I can show you how to be totally out of debt, let's say in the next 5 years. And that means for the next 25 years, you can redirect money that was previously earmarked to pay off debt into your retirement program. How would that change your life?
That would change a lot of people's lives. I can imagine that. Absolutely. Dale, I'm going to switch and two things I'm thinking about. One, if you can in the chat, maybe you've got the name and all, but put down there how people can contact you via email or cell phone to get more information. But
Okay.
I want to switch a little bit in terms of how did this become, and I'm getting maybe a little personal, but how did this become your passion? Because listening to you, I sense and feel a great deal of passion and drive that you found your, shall we say the word would be your niche, so to speak, or your calling.
Calling.
Yeah. Why did this become at this stage of your life, your calling, your passion?
Okay. That's not very difficult for me to answer. It happened or came along, Nat, when I was at Fannie Mae.
Okay.
And our mission at Fannie Mae was something that really resonated with me.
Mm-hmm.
At Fannie Mae, we're in the American dream business. Our mission is to tear down barriers, lower costs, and increase opportunities for affordable rental housing and home ownership for all Americans, because having a safe place to call home strengthens families, communities, and our nation as a whole. I have never worked for a company that had a mission statement that resonated with me like that. I felt like I was making a difference every day.
Okay.
Okay. So that's where some of that passion began. While at Fannie Mae, we partnered with FDIC, and we had a program to stamp out financial illiteracy. Okay. So it was while at Fannie Mae, I became a financial educator with that program, and I started going around talking to people about stamping out financial illiteracy. And I became very passionate about it. And I knew then that whatever happened after I left Fannie Mae, that my life was going to be committed to that mission. And that's why I have such a passion for that today.
Fantastic. Fantastic. Great. Thank you for that answer. If there's any other questions for Dale, please put them in the chat. We're talking with Dale Dix, President and CEO of SageOne Financial, and he is talking about financial literacy, generational wealth. Why is it important to have a financial planner? Dale, what words of wisdom, now that you've been in this business for quite some time, you've acquired a great deal of knowledge and all, what words of wisdom or thoughts would you want to pass on to our panelists, attendees today? And since it's being recorded for people to listen to it and watch you again, what words would you pass on to them?
Okay.
As individuals, as well, family and business owners, all three.
Yeah, and I'm going to talk to you guys like we're all family here.
Okay.
And, I believe that there's never been, as I said earlier, a better time in the history of our country to be in business for yourself.
Mm-hmm.
Okay. And the current global nature of the world, and thus business, further enhances the allure and the prospect of unprecedented growth in business going forward. But I'd be remiss if I didn't remind you that business ownership is hard work. And it's much as everything else is that we do in life. And unfortunately, there are going to be a lot of losers and a lot of winners. But those who are able to persist, who are able to hang in there, will be winners. And I'm reminded that between every stimulus and response, there's a space. And in that space, there's an opportunity to choose. And that choice defines who you are. Okay? Freedom isn't free, but business, having a business of your own, is along the road to freedom. And I believe that going forward, there's going to be more opportunity to be in business for yourself. Many people out of necessity will have to go in business for themselves.
Okay.
So for those of us who can embrace that idea and for whom it's a good fit, I think the sky is the limit going forward.
So you would think now, I'm listening to you, you're optimistic as it regards to the economy, or shall we say just the nation in general.
Yes.
Great.
And but I'm coming from a very peculiar state of mind, Matt, in that I believe that you're a business owner, Nat.
Mhm.
So I know you understand that you know, when we worked for someone, when we were in that job, that job, just over broke, right? That's a security mindset. Okay, what do I mean by that? Well, we choose a job because we can go to work every day, 9 to 5, what have you, and we know we're gonna get paid for those 9 hours, and we come back home. When you're in business for yourself, you could work all day and not make a dime. Okay, so when you choose a job, I call that choosing security over freedom. Now, when you choose business, I call that choosing freedom. Okay, and I love freedom. I don't like security. Okay, so that's why I'm so optimistic about the future of being in business, because who doesn't want freedom? And the only way you're going to truly have freedom is to be in business for yourself. And you're going to work harder than you ever worked for somebody else. but that's the joy of that freedom, right?
That is true. That is so true. When you talk about that freedom and working hard for yourself. Absolutely. Any other questions for Dale Dix, our guest for tonight, with the panelists in there? Thank you also, Nan, for saying that this was very informative to you. And that's what we try to do during our business showcase. This was a different twist because we had an expert in financial planning and generational wealth, even though he may be a little modest, may want to admit all of that. But I think we learned a great deal about what we should do in terms of securing our financial future. So Dale, I'm going to give you the last closing remarks. Any closing remarks for our guests tonight?
Yes. I would be remiss if I didn't put out there, because first and foremost, I'm a personal finance educator, and I perform educational services, in most cases complimentary. So if anyone out there or organizations that you may be a part of would be interested in my complimentary personal finance education training, please give me a shout. I'd be more than happy to talk with you about how we could go about making that happen. There's a virtual option as well as an in-person option, depending on, you know, the distance between us. So that's what I wanted to leave you with, Nat.
Well, I thank you very much, Dale, for sharing your expertise. I learned a great deal now, and I'm going to pass it on to my friends and particularly my family members and say, look, we've got an expert in here. You need to listen to what he's talking about. And I agree in closing too. Financial literacy is really something we all need. And we need those refresher courses out there because, as you admitted, things change. And the new products and services are out there, as well as even our needs as individual owners and family members, they change. And so the critical factor that we talked about was setting a financial plan to ensure generational wealth. And that's what we're looking at. So again, on the behalf of the Howard County Library, and Nancy's going to say a few words too, and on the Ujamaa Business Roundtable, Dale, thank you very much for taking time out to share your experience and we thank you also for your service as a Marine Corps veteran. We thank you for your tenure at Fannie Mae, and we definitely thank you for tonight giving us a great deal of information as it relates to our financial security. So again, thank you so much. Nancy, I turn it back to you.
And thank you, Dale. We want to thank you for your service to our country and for sharing your story tonight with us, and for your passion and commitment to helping people increase their financial literacy. We want to thank Nat for moderating our discussion. A reminder that the roundtable meets on the 4th Tuesday of the month at 7 p.m. And we want to thank you for joining us tonight, and we will look forward to seeing you at the next roundtable. Good night, everyone.
Good night. Good night. Thank you, Dale. Good night. Thank you, Nancy.
Bye-bye.
Bye now.